Pardon me. Okay, got a couple of good, interesting questions in the break there, so we'll raise them in the discussion later. Right. So the core argument I'm giving you here is that in the fractal markets hypothesis, it's arguing that what's superficially random can actually have a deterministic cause. And that applies if there's sufficiently strong feedbacks, such as the example I gave you in lemmings, where you subtract the square of the number of lemmings from the number of lemming births, and that gives you the incredible volatility, or you have two variables multiplied together as in the Lorentz equation. And then what you get is what's called chaotic behaviour or complex cycles. And that can be cycles which are no longer regular, like with sines and cosines and standard. Again, it's a bit like the integer variations of sine and cosine. We get non-integer stuff where there's no given period to the cycles, but there are still cycles. And therefore, it's incredibly hard to predict it for more than a few periods ahead. And that's even if you know the underlying dynamics absolutely precisely. So that's another way to explain why it's hard to beat the market. And Peters was the first person to apply it to the stock market. I highly recommend his two books. Very readable, very well explained, even to the stage where you can actually read his arguments and work out how to apply the mathematics he puts forward to characterise the market as chaotic. And he says the market overall is a chaotic system where stability occurs, where there's a wide range of investors with different horizons and different beliefs. Now that's, if you think about it, that's the exact opposite of what you get out of the Inefficient Markets Hypothesis, which says that you get stability because everybody accurately predicts the future. Here it's saying you get stability when people have very different ideas about what's going to happen. And in fact, when everybody shares the same expectations, you'll get crashes or booms. And then what you get out of it is a pattern that looks, again, self-similar, not quite as beautiful as the Mandelbrot pattern, but when you're looking at a daily behaviour, you can see crashes of the same scale that you see when you look over the very long term, like over a century. And I want to give a bit of an illustration of this. Here's 4 slices from the Dow Jones. One of them's pretty much a whole century, another's roughly a decade, another's about a year, another one's a day. So I want you to have a bit of a guess, which is which? Which is the century, which is the decade, which is the year, which is the day? So write it down yourself, A, B, C or D. I just want you to pick the two extremes. Which is the day and which is the century? Which one do you think is the day? Okay. Century's D, you think? Okay? B. Okay, let's go. Me and my hearing. C. I told you I got great hearing, didn't I? I'm not lying. Okay, let's go for a poll. Who goes for A being the century? A smattering. Who goes for B? Nobody. Okay. Who goes for C being a century? Fair few. Who goes for D? Okay, reasonable number. Okay, that's the century. You got it right. Why did you get it right? Because of the big dip at the beginning there? Okay. Okay. That's the decade. That's the year, and that's the day. Well, it's last Friday. Now I've got a feeling that I would say the most similar to me of those two appear to be the day and the century. Okay. So when you adjust for time scale, you get a very, very similar pattern. And that's just like zooming in on the Mandelbrot plot. The same structure appears at all scales. And that's partly where both crashes come from, but also stability can come from that. And so for all these various markets, Peters found a fractal structure. And that's compatible with some other theories I'll be talking about later. I'll be talking a bit about the Inefficient Markets Hypothesis later in this lecture, and the Financial Instability Hypothesis will really form the basis of the remainder of the subject. But they're incompatible with the Efficient Markets Hypothesis, and they're based on and certainly the Fractal Markets Hypothesis is based on the idea of heterogeneous agents, not identical, but very different people with different expectations and different time horizons. And the crash occurs when they all shift over to the same time horizon and the same expectations, and equally a bubble can occur there as well. Now, one thing Peters does is give a lovely illustration of how this heterogeneity normally gives you stability. So here's an extract from the book itself. He says, take a typical day trader whose horizon is 5 minutes, and they're currently expecting the market to rise. In the period he was looking at 1992, on a 5-minute basis, the average change was negative, and the standard deviation was pretty small. Now, it's quite possible for a 6 sigma event to happen in one day. As I said, any scale event is possible on any time scale series. So even a 22 sigma movement could happen on a single day on that basis. But here we're looking at a 6 standard deviation movement. Now, if the agent was following sort of efficient market type idea, that's enough to wipe him out because he wouldn't be hedging against the possibility of having a 6 sigma movement. But an institutional investor in the same market at the same time who's got a weekly trading horizon would think that's possibly a buying opportunity, because if you're a weekly trader, your time horizon is larger. And if you look over the past 10 years, around that time period from 1992 forward, it was a rising market. So what's a really, really big turn to the day trader makes no difference to this long-term trader. So what's a 6 sigma movement for the day trader is a 0.15 sigma movement for the weekly trader, a buying opportunity. Step in, buy the market at a bit of a discount, and that stabilises the market. So that's the interaction between varying agents giving you stability in the market. Now, one thing he doesn't use the box counting dimension, he uses what he called the Hurst exponent, and that's a similar measure. It's rather more complicated than the box counting dimension to work out. That is covered in chapter 8 of his book, and if you actually get that as part of your reading, then read this next few slides before you read chapter 8, just to make it easier to get through. Again, I'm not expecting you to reproduce the technique, but just to understand the basic idea. And again, it's another way of showing how the market is fractal. Now, the key insight with all this against the neoclassical idea of efficient markets is, first of all, scale invariance. There's no standard size of anything, and therefore you can't rule out extremely large movements in either direction. So if you had an investment strategy based on that, which a certain firm called Long-Term Capital Management in fact had, well, it's not particularly amazing, you're going to get it wiped out. And it's a bit like saying for earthquakes. You have to expect any magnitude of earthquake as being feasible over some time period. There'll be many, many small ones than large, but you won't have vanishingly rare. The large ones won't be vanishingly rare, they'll still happen. And even weird things like bubbles in a bubble bath. If you look at the size of the bubbles, you get some very big ones, you get lots of very, very small ones. Daily movements in the stock exchange, any size crash can happen. And the likelihood of that happening is far bigger than you'll get out of any model using a random distribution. So what you see as crashes and see as aberrant behaviour, if you look from the efficient markets point of view, is actually the normal behaviour of the market. So I'll give you an example again in stock markets, in the real world, of earthquakes later on. But here's a few of the various systems where this applies, including species extinctions, meteor impacts and so on. So in economics, applying it to the finance market, and saying how often are you going to see a huge crash, again you'll find the log of the number of movements of a particular size is going to be related to alpha times the log of that size. Ditto for recessions. There's a good paper by Paul Ormeron covering that, looking at recessions over the last 1.5 centuries. And if you look at the size of firms in the American market, you'll find the size distribution also follows the power law scale. So the obsession that neoclassicals have with perfect competition, there is no such thing as a competitive industry as they define it, nor a monopoly. Most industries have got a wide distribution of firm sizes. If you look at the entire economy, there's definitely a power law there. So there are empirical regularity in dynamic systems, and they should be part of how we think about the economy as well. Here's an illustration of applying it to earthquakes. This is part of Southeast America, United States of America. I think it's near Texas and Wyoming and Missouri, Arizona. That's the little rectangle here. What this data is looking at is all the earthquakes in this region, and then saying how many earthquakes at a given scale occur over a century. Here's the Richter scale, which is a log scale on the horizontal axis, and there's the number per year on the vertical. Now, if you look at how many there were of a scale of about 1, there's over 100 earthquakes that big in that region every year. If you look for earthquakes about scale 2, it's about 10. For scale 4, there's about 1. So the linear relation applies right out to here. Every 100 years, you're likely to get one earthquake of at least magnitude 6 on that scale. Now, I showed you the same relationship with the stock market. The coefficient was 3.96. So it's a non-equilibrium behaviour. And again, this is common in genuine sciences. It's about time we brought this into economics. And to try to understand what's going on, an excellent analogy was a whole process is made by a guy called Per Back, who wrote a beautiful book called How Nature Works. I highly recommend having a read of that. People want to see how you can apply mathematical logic to what we see happening in nature. And he said you can make an analogy to earthquakes from the simple illustration of taking a bucket of sand, dry sand, and pouring it very slowly onto a flat surface and watching what happens. And what you'll get for a while, the sand will spread out. Then it'll start to stack up because the sand, once it forms on the flat surface, gives a structure for other sand grains to stand on top of. The pyramid will get higher, and there'll be little landslides every now and then as the steeper it gets, the more they're likely to tumble a fair distance when it pours out of the bucket. But every now and then there'll be big collapses. It'll go thump, and then spread out very dramatically that way, and then build up once more again. So there'll be a big landslide every now and then. Then it'll pile up from that level and go through the same process again. And the way that Per Back described it is to say that a big avalanche is a small one that doesn't stop. Okay? Because one avalanche causes another, mini avalanche causes another, and the whole thing builds up, and then the energy is dissipated, and then you start the whole process again. Now that's a dynamic but discontinuous process, very, very different to how economists think in terms of equilibrium. And the intriguing thing in this book, Per Back had a bit of a chat about what he thought about economics after he'd taken a bit of a look at it. And this is a seriously well-qualified and well-respected physicist giving his views on how economists obsess about equilibrium. And he's talking about, when he was writing, general equilibrium was seen as the pinnacle of the discipline. These days they're into, Nash equilibrium, and they've gone into what they call dynamic stochastic general equilibrium models. But back in these days it was general equilibrium theory. And he says, in equilibrium, no agent can improve the situation by any action. We're discussing that in break with one of the students here. And in equilibrium, small perturbations will cause only small disturbances. So again, the earthquake analogy won't apply in that situation. And therefore, to get a big response from the system, you've got to hit it with a big shock. And that's how neoclassical economists have tried to explain the global financial crisis. You can only get a large fluctuation in an equilibrium system if by sheer chance a huge number of random forces all point in the same direction at the same time. Therefore, equilibrium, he says, doesn't explain what happens in stock markets. Now, it's a simple a priori set of reason. You could say, given what happens in the markets, you can't possibly describe them using an equilibrium process, but that's what, of course, economists do. So he says we have to accept instability and catastrophes as inevitable, the norm, not the obsession, not the exception. And you have to also abandon the idea of detailed long-term determinism, which a lot of economists get caught up in. But certainly you can predict ahead in the small future and say there'll be some pattern here. So he's arguing that even though there are many, many small events, the very tiny number of big events really determine the overall behaviour of the system. And therefore, if you rule those out, you're not actually understanding the system at all. And he talks about this thing called self-organised criticality. Now, there's another piece of jargon for you, from another world. And what that is an attempt to explain how we see this power law behaviour operating. And that's partly where the Sandpile analogy comes in, because the slow change over time can accumulate a set of forces that mean the next small impetus causes the whole system to change its structure. So the old analogy, the straw that broke the camel's back, is a bit like that one extra grain that when it lands causes an avalanche that breaks the structure of the sand pile. Now you can still model these by using dynamic modelling techniques. They have limitations, but if you have a dynamic process which generates the same sort of characteristics of the unstable equilibria and the instability being what you can call critical rather than overwhelming. Now by that I mean you get a big jump, but you don't get, for example, negative prices turning up. Then you can model it that way, and what you find is those systems tend to live on the border between being ordered and being in chaos. If you think about that sand pile again, it's normally stable, but it'll suddenly change. And what you've got is fluctuating from a stable state to an unstable, and then back to a stable again. And there's a technical way for working this out called a Lyapunov exponent, but that, when you look at most dynamic systems, we find that the Lyapunov exponent actually hits the value of 1, and above 1 is unstable, below 1 is unstable. Most evolutionary systems seem to converge to about 1. Now, for more on the Fractal Markets Hypothesis, have a look at Peter's, and I've embedded that particular chapter at the end of this particular set of slides. But I want to now move to looking at what are the analogy to the grains of sand in the individual market that explain what we actually see, this fractal behaviour, what's actually causing it at the individual level. Now clearly you can't use the EMH to explain what's going on there because it assumes that investors can accurately predict the future. They all agree about it, they're all correct. Now the reality is the future is uncertain. So our behaviour is the behaviour of investors, or I'd prefer to call you speculators when you play in the stock market. Speculators not knowing the future but still having to make a speculation. I get emails all the time from people asking me how I'd advise them to do what to do with their possessions right now. And first of all, I've got to say I'm not a financial advisor. I can't give financial advice, so I don't answer the question directly. I'm going to give a vague answer in some way, but you simply can't stand still in a system that's as unstable as the one we have. So Keynes said, how do most people behave? Well, what people normally do is they form conventions about the future. And those conventions are driven by uncertainty, not risk. He says you can't possibly work out what the returns are going to be for a share. So the whole idea of CAPM that you had bumped into your heads with other courses in finance, Keynes just basically rules it out and says our basis for estimating the returns of an investment in the future amount to very little. And people who actually work that out end up being such a minority in the market that they don't have any real impact on where it goes. They're a bit like Warren Buffett does it successfully, but he, even though his share company is enormously influential, his influence on the market is comparatively small. So you can't know the fundamental value, whereas CAPM, of course, says you have actually worked out what the price should be based on fundamental value. So shares are always going to have a speculative valuation. And based on the conventions, Keynes says these are the main conventions people build. First of all, they assume the current situation is a serviceable guide to the future, in a way that if you took a careful look at it, it'd show it had never been the case in past history. Secondly, we assume that current prices accurately sum up what's going to happen in the future. And thirdly, one of those wonderful phrases from Keynes, we endeavour to fall back on the judgment of the rest of the world, which is perhaps better informed. So we go with the herd. There's a herding behaviour that turns up as well. So it's not rational in the sense of rational calculation, but it's speculative behaviour in the face of uncertainty. In the real world, a rational person speculates. That's fundamentally what Keynes is saying. What that gives you at the collective level are the booms and slumps we see turning up in that data, the fractal data that describes the stock market. And what he's saying here is, again, this is some of the best of Keynes's writing in chapter 12 of the General Theory, which again is one of the readings for the course. He said that if you have a valuation based on that sort of behaviour, it's going to be liable to change violently as a result of a sudden fluctuation of opinion due to factors that make not really much difference to prospective yield. And you're seeing that dramatically right now with the stock market going up and down by 4% amounts in a single day. And he says this may be in abnormal times in particular, and I think we're living through a very normal time right now, where the hypothesis that the continuing state of affairs is going to remain indefinitely is even more unrealistic than usual. The market will be subject to waves of optimistic and pessimistic sentiment, this beautiful phrase here, which are unreasoning and yet in a sense legitimate when no solid basis exists for a reasonable calculation. It's a deep, mature understanding of what's happening in the markets. And as I mentioned a couple of times, Keynes described himself as a speculator who lost 2 fortunes and made 3. So he's in a fairly authoritative position to comment on all this. And he says, how do you make a profit in that situation? Well, you profit by getting shifts in confidence. And he says what you actually do is you're not making forecasts about the shares at all. You're working out when there's going to be a change in the conventional valuations a short time ahead of the general public. That's what will make you money in this market. And so that's the inevitable result of an investment market organised in this way, because there's no point in paying 25 for something which you think is going to be worth 30 if you also think it's going to be valued at 20 a short time in the future by the market. So markets are conducted by speculation on the immediate behaviour of other speculators, and that's what gives you that incredible volatility. That's the sandpile in the stock market. So he also made a wonderful analogy of being like a beauty contest. And if you actually want to build a decent model of the stock market, this is a good starting point. He used the example of the newspaper contest from the sexist 30s, where you might be asked to pick out the 6 most beautiful faces from a profile of 100. And the person who wins is the person whose guess most closely corresponds to the average of all the competitors. He said the way you do that is not by picking the objectively most pretty face, or by checking the face that average opinion thinks is the prettiest face. You've got to pick the face that average opinion expects average opinion to think is the prettiest. That's how you make the money. Now he said that is bizarre. That's not how we should be using our intelligences, but that's what the stock market makes us do. And he says, you simply can't do the long-term speculation that people, the long-term expectations that conventional theory says you do. Now, of course, Keynes is writing about conventional finance theory of his time. We've now reproduced it times 10 with the efficient markets hypothesis. And there's also a way in which what happens on the stock market reverses the sort of standard micro you get taught anyway. And neoclassical theory is always trying to shove things back into supply and demand curves. Now, I've shown you that normal micro doesn't work, but nonetheless what it says is supply is a positive function of price and demand is a negative function. So, and they're supposed to be independent of each other. All of those three things are false. But if price rises, then supply is likely to rise, demand will fall, and you get a tendency to go back to equilibrium again. But if you think in finance markets, supply, well, you could argue that's a positive function of price. Maybe more shares are put on the market when prices are rising, but demand's also a positive for price, or the rise of prices. If you think of the share price going up, that's more likely to make people want to buy that share because you want to buy and sell it on a rising market. And to some extent, the faster the rate of price appreciation, the higher the rate of growth of demand. Now that's a reason to expect to move away from equilibrium, again, to give you those booms and busts. So pricing is going to destabilise the market rather than stabilise it, and that means that you're going to get overvaluation of popular growth stocks, so-called, and undervaluation of so-called value stocks, the sort of stuff that Buffett tends to invest in. And this is another reason to say why it's going to be hard to beat the index, or why, not so much that it's hard to beat it, but that most people fail to beat the index. And that's now the inefficient markets hypothesis. Now this one argues that investors react slowly to news. Think about how people behave. They've got a set of beliefs they start with. When news comes in that disturbs those beliefs, initially they don't react to it. Then after a while they overreact to that news because it surprises them and they suddenly shift their behaviour. And they also at the same time ignore the fact that no company can outperform the market forever. You will get reversion back to the mean over the medium term. So what happens out of that? A series of good reports leads to expectations of more good reports, and therefore the firm valuation or the industry sector's valuation rises and it becomes regarded as a growth stock. And that rise becomes self-fulfilling after a while. People buy because the price is going up. Now the firm can't sustain that above sector performance, nor can a sector maintain above economy performance indefinitely. So there'll be some bad news and that the results won't be as good as people are expecting. And initially that'll also be ignored, but ultimately bear valuations will set in and you'll fall back, the price will collapse after that. So the growth stock will therefore underperform in the medium term. And this, again, a bit like Keynes's argument, is saying that most of the variation you see occurs because other investors are watching the behaviour of other investors, not because of the news itself. So this is the way you might characterise what goes on with the efficient markets hypothesis. You have a bunch of investors, all of whom have got identical expectations about what their investment opportunities are. A bit of random noise comes in from the real world, and that leads to the share market valuation, which is accurate. What's actually going on is a bit like this. You've got a whole bunch of speculators watching what each other are doing. There's an overall mood that comes out of the market as well. They'll have bears and bull markets. There'll be investment opportunities, sure, but you're also watching the expectations of other investors, and there is randomness as well. That'll give you a share market valuation that again feeds back on what expectations are, and back we get up here again. It's a messy, complicated, volatile system. Now the key arguments out of the inefficient markets hypothesis is the exact opposite of the efficient markets hypothesis, and that is that shares with low volatility are likely to outperform the market. Okay, the opposite of the advice you get from the efficient markets hypothesis. And the market will be characterised again by the slow reaction to news, under and overreaction, and also the hypothesis also argues that institutional investors behave differently to individuals because they're forced by their short-term horizon. They've got a 3-month reporting cycle, most of them. They have to come at least near the index. So they're forced to behave much like the index itself. And therefore, if you're an individual or if you're a hedge fund that doesn't have the limitations of a quarterly reporting cycle, you have an advantage. You can do things that they can't do. And the best thing you can do is buy bad stocks. Now again, this is the opposite of what you get out of usual behaviour, but it's saying stocks that are doing poorly now are more likely to have better growth potential in the future and a lower downside in the future. Now that's not a guaranteed. You could buy, I don't know what's going to happen to Hewlett-Packard, but now they've got out of the personal computer industry, maybe if they're on their way out, you could buy that one bad performance now, it'll return. Maybe it'll die, who knows. But certainly in the general statistical sense, this hypothesis argues that if you bought a whole swathe of companies that are doing quite badly now, you're more likely to do well in the future. And the reason for this is companies that are doing well now can tend to get complacent. And they also are going to attract competitors. Google is clearly facing that fate all the time, though it still tends to be beating most of its competitors. That'll give those firms high stock market valuations. Now, companies with poor results are going to face the pressure to improve or die. Some of them are going to die, others will improve and keep on going. And if they're in a dull industry, like for example making soap or bitumen, they're not going to get many competitors and they'll get low stock market valuations. Now, the inversion of performance for both those groups means that the good results will be followed by poor ones and vice versa, poor by good ones, the reversion to the mean. So if you buy the stuff that's out of favour now, you're likely to get that reversion to the mean benefit, and therefore gives you a contrarian strategy of buying poor performers now, which won't make you money in the short term because of that market overvaluation and the herd effect, but it will work in the medium term. So that is the philosophy that even if you do badly, like you buy a bitumen manufacturer and its share price doesn't rise all that much, because its share price is going to be low and it's in a stable industry, it's likely to give you high dividends anyway. So anything you might lose in appreciation, you'll gain in terms of dividend performance. So non-institutional investors can outperform the index by using this approach. So they argue. But of course, that's not what most individuals do. Because here, you, again, according to this hypothesis, you find self-defeating behaviour at the same time, because people will follow the advice of gurus and therefore all do the same thing, fail to diversify, they'll churn their portfolios and they'll sell winning stocks and hang on to losing ones. And that undermines both hypotheses, both the efficient markets hypothesis and the argument that you can make a gain out of market inefficiency, but it also partly explains where the inefficiency comes from. And ditto money managers, again, this hypothesis now overlaps with what Keynes was saying earlier, because, again, Keynes said at one stage that if you're a professional manager, it's better to fail conventionally than to succeed unconventionally. And I don't know that Hagen, the guy who wrote the Inefficient Markets Hypothesis, has read Keynes on that front, but he's saying exactly the same argument here. They choose portfolios that are excessively close to the benchmark so that they minimise the risk of underperforming it. And they select the same stocks others do, again to avoid falling behind and looking bad. And they buy ones that have done well recently and sell ones that have done so poorly. This is another author writing on the same idea. But same basic concept, that there's herding behaviour by both individuals and investors. So if you have the stomach for it, you can make money by exploiting the behaviour of those two groups. And there's advantages that the fund managers can't take on and that individuals tend to miss. So the way to go about it, according to this hypothesis, is to buy stocks that have got a high book-to-market ratio, that are in sectors that are out of favour and that have low volatility. And the reason I used the example of soap and bitumen earlier is that Buffett did precisely that during the 2000 period. His 2000 and 1999 newsletter told his investors that your company has recently bought a soap manufacturing firm and a bitumen plant. He said, try to contain your enthusiasm. Okay, totally out of favour sectors, but a worse performance over the short term because he didn't get the bubble of the internet, but over the medium term he didn't lose any money out of it, and those firms continued improving, good results, they came out ahead. Now, the main guy who's pushed this forward is a guy called Bob Hagen. He was an academic. You will find a textbook by Bob Hagen in the library here. Take a look at the appendix, because you'll find that in the body of the book, he wrote the usual neoclassical stuff about the efficient markets hypothesis. But in the very substantial statistical appendix, he trashed it very carefully. And he resigned because A, he wanted to make money out of what he'd worked out, and B, he was sick and tired of putting up with the crap he got from his fellow academics. And he actually has he had a little story in one of the books where he has I think it's The Beast on Wall Street. He actually has a fictional story of somebody who has his ideas being persecuted and eventually assassinated by other academics in finance. I'm not quite that paranoid, but very, very lively stuff anyway. And what they show is, first of all, the empirical failings of CAPM long before you saw the same thing being said by Fama and French, and also ways to profit from that market mispricing. So one thing he looked at was a book called In Search of Excellence, which came out in 1980, or shortly after 1980, and said, here is a whole range of excellent firms on the basis of a whole range of criteria versus some unexcellent ones. Another author went along about 7 years later and checked and saw, well, how would an investment have gone if you'd bought a portfolio of excellent ones versus a portfolio of the unexcellent ones? And the result was you would have done better if you bought the book and bought the stocks it told you not to buy. But here's the excellent ones, high asset growth, high equity growth, high book to market ratio, blah, blah, blah. Those are the unexcellent ones. So if you actually put $100 into a portfolio, about a weighted portfolio of the excellent firms, of the unexcellent, you would have tripled your money over a 6-year period. If you bought the excellent ones, not a bad increase, but less than you get out of the unexcellent ones. Now what Hagen is saying, well, where does that come from? And it's largely, again, regression to the mean. New entrants come in, firms that are in low return businesses get out, therefore good performance in the past may be inferior in future, whilst poor ones may do better in the future. And a whole lot of similar patterns were found by Hagen. So if you look at future returns to stocks, what should you buy? Cheap ones or expensive ones? Now cheap ones, of course, have got a high book to market ratio. And if you look at their earnings, they've got a high dividend yield versus a low dividend yield. So he ranked firms by earnings and by dividends, and then looked at the performance of the most expensive and the least expensive quartile over the subsequent years, looking at both high price to earnings versus low and high dividend yield versus low. And of course a growth stock is going to have a high PE and a low yield. This is what you got. Put $1 into those various investments. That's what you got from a high price to earnings ratio. That's buying a growth stock. That's what you got by buying a low price to earnings, a value stock. A pretty substantial difference. Rather than having $15, you have 90. 6 times return over a period of what? 30 years. So a high dividend yield and a low price, they do better over the medium term. And looking again at taking a look at these cheap and expensive quartiles and looking at the returns over cumulative 5-year periods, you again get the tendency for cheap stocks to outperform the expensive ones. And what he redefines efficient to reclaim it from economics for the English language. When he says efficient, he means what works, okay? Not what the Inefficient Markets Hypothesis means by predicting the future. So what he finds is the efficient way to design your portfolio is to make up one that has low volatility and high return. And you get the opposite correlation out of his results to what you see in CAPM. So here's the result of having, there's the overall S&P 500. That's what happens if you go for, take the stocks out of that have got lower volatility. You get a higher return. If you go for high volatility, you get a lower return. He's looking over the 10-year period with a small firm stock index. So you take a particular subsection of the market now. That's if you take the ones with low volatility. That's the ones you take the ones with high volatility. Take the large firm index. Same story. looking for low volatility gives you a higher return. It's the opposite conclusion to the efficient markets hypothesis. Value stocks, even looking at value stocks, take the value stock index, which of course are shares that have got a low valuation on the market now. Take the lowest volatility of those, you get a better return. Higher volatility, worse return. Ditto for large value stocks. Not quite as big a shift, but the same sort of story. Looking at growth stocks, even you stick with small growth stocks versus, looking at small growth stocks, take the ones with lower volatility, you get a higher return. Take those with high volatility, you get a lower return. Ditto for large growth stocks. Okay. The slope is the wrong way around according to CAPM, but it's the right one according to the data. So he's saying here, let's again take a look at the low versus high volatility relative to the S&P. And now what he's saying, let's position the S&P on the middle of a graph of risk of return. So it's the 0 point. CAPM would tell you that the higher volatility would give you a higher return. Therefore, looking at the graph, it should slope upwards and to the right. In fact, it tilts in the opposite direction. Here's looking at return versus volatility on the horizontal and return on the vertical. That's what CAPM predicts. S&P's in the middle. There's where your low volatility portfolio actually turns up. That's where the high volatility portfolio actually turns up. So again, you're reversing the predictions of the accepted theory in economics. So lower volatility gives you higher return. Now, he's saying what's going on behind that? Well, the people are overestimating the short term. So what they see is the actual true horizon. They extend it further than it actually works out to be, and the level of growth they expect is higher than actually tends to turn up. So again, you've got what you might call irrational behaviour. Really what you've got is speculative behaviour under uncertainty, and then herding coming out of that because we accept each other's opinions of what's going on, but then reversion to the mean actually happens in the real world. So growth stocks perform well in the short term, but disappoint in the medium term. So here's his way of showing it graphically. There's the relative growth level, there's the average, there's above average, and there's below average performance. What people perceive is that sort of growth horizon applying to the above average firms. What actually happens is that it cuts off earlier, so investors expect a higher return for longer coming out of the leading firms than actually applies. And therefore they overprice growth stocks in the meantime, and they reduce the price in the medium term when it starts to revert to the mean. But if you look at the actual versus the true growth horizons and average growth rates, they overestimate their average growth rate as well and how long that's going to apply for. So look at that graphically. You see here you have above average, just the perceived average, below average, and the actual average into the future. That's what people think is going to happen. That's what actually happens. So the truth growth average, if you're above average, you're well below what people expect anyway. So you're overestimating all the way through. So investors expect current growth will be higher than it turns out to be and last longer than actually occurs to be the case. And therefore they overestimate the average for the industry as well. So this partly is another way of explaining that fractal nature I showed you, the underreaction to initial good news, then overreaction to it, and then reversion to the mean. That's all going to give you that volatile up-down process in individual stocks and in sectors. And as an individual level, it means you can profit from that by analysing the stocks that have got low volatility, a high book-to-market ratio, or an out-of-favour sectors, and then develop a portfolio of those stocks and adjust them on a quarterly basis. And according to Hagen, you'll come out fairly massively ahead. Now again, to give you an idea of what that might mean, here I'm using data from FAMA and French, and I'm looking at stocks based on their book-to-market ratio going back to the early 1920s, and say, let's rank them by book-to-market value. And of course, some companies are going to be making a loss. So they're going to have negative book value, like a lot of the internet companies were negative valued in 1996 to 2000. Others will have a low book-to-market valuation, so therefore they're going to be the growth stocks, the stocks that people expect to rise in value over time. The medium and then the high ones, so the value stocks that Buffett would normally go for. And look at what would happen if you put $1 into each of those segments over an 80-year period. So $1 goes in 1926. In 2009, you'd have $16 if you bought the negative book-to-market portfolio. You'd have $1,000 if you bought the low book-to-market, which is pretty good. $2.5 if you bought the medium range. But if you bought the ones which had a high book-to-market ratio, you had $14,000. A pretty extreme change, and so extreme you can't even show anything other than a log chart. So there's something here that applies over the very long term as well. Now Hagen is no longer an academic. He's now running his own company, selling that advice, selling a portfolio based on it. And there are many other companies out there to try to exploit these inefficiencies in the market. And there are indeed even systems based on Fractal Markets Hypothesis. Now I haven't checked any of these out. You might take a look at them yourself, but there's one. Okay, it says put your money in here. We will apply a completely automated system to trade with your money. We won't tell you the formula, okay, but that's what we're doing. So for further details on that hypothesis, have a look through Peter's book. So it's an extremely good read. He has 2 books out. I think maybe a third be coming out shortly. Well worth a read. And that gives you, of course, a completely different perspective on how to make money in the market and what to do with investors' money.